Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is our live Q&A, and I'm hoping it goes better than Monday night. If you were watching, apparently the audio and video is terrible. I tried to blame Michigan, which is generally my sort of go-to explanation for anything that goes wrong, that somehow, the problem started somewhere around the Ann Arbor area. But unfortunately, I'm pretty sure I'm to blame for the Monday night fiasco. Uh, and I think it was nothing more than I needed to restart my computer, um, honestly. So a thumbs up from anybody if you can hear and see me and it sound like that, hopefully. Um, and I called this show, I have to come up with a new title for every live Q&A, which kind of gets difficult since I'm now doing 2 a week. Thanks, Tyler, for the thumbs up. And Salty's back. Yay, Salty. I called this the life-changing magic of index funds. The reason this came up is that I get people reach out to me now. I guess, I don't know. I guess we're a big enough group that people, that companies want to advertise to you guys. They want access to you through me. And so I'm the gatekeeper. And I get this, I've gotten this one email from a trading a brokerage platform. You could think it's like Robinhood, but not Robinhood. I've probably gotten a half a dozen emails from their marketing department. And in the last one, they said, look, Rob, you really need to promote us. Look at all of these other YouTubers that are promoting us. And they had this graphic with their pictures and the number of subscribers they have, many of whom I'm sure you've heard of, some of whom I know personally. And I thought, really? Why are you guys? I mean, I don't want to be critical of other YouTubers. We each have to make our own choices. And I shouldn't be critical. But the reason I won't promote them is the same reason I won't promote Robinhood. At least I won't do it on YouTube. I don't promote them on my blog either. But if I were doing a roundup of stock trading apps, I would obviously have to include Robinhood. It's just become too popular. In any event, I just delete their emails, and it occurred to me that the entire financial world of investing depends on a couple of things. One, they want really two things: active trading and complexity. If we remove those two things, many of the businesses that we know would be gone, right? Robinhood cannot exist. If everyone on Robinhood were passive, low-cost index fund investors that maybe make 1 or 2 purchases a year, or 12 if they dollar cost average every month, they would not exist. They couldn't survive, right? And for that matter, probably many of the big brokerages couldn't survive without either, again, complexity or active trading or both. And I just, that to me is part of the beauty of index funds. Of course, you can be an active trader with index funds, and you can be a passive investor with individual stocks. If you, have a core group of stocks and you buy and hold for a long time, I mean, to me, that's one way to be a passive investor. Probably not the best way for most people, myself included. But if we can eliminate, the more we can eliminate active trading and complexity from our portfolios, I think the better. And so that's why I named today's show what I did. By the way, happy to take recommendations from you all about what I should call this thing. Anyway, so if you want to ask a question or have a topic discussed, just tag me in your comments. There will be timestamps after, probably later tonight below the video. And I think that's it. I had one other thing, but now it escapes my mind. It wasn't that important as I recall. Oh, no, it's very important. One more thing. Question. Take a good look at me. Is there any world in which I could be 83 years old? I know I've got gray hair. I get that. I got a comment to my last video, which was on HSAs, which by the way, I embarrassingly called health spending accounts in the video. I get them confuzzled with flexible spending accounts. What can I say? In any event, I alluded to the fact in the video that I'm in my 50s. And a commenter said, I don't know who, I don't think it was a regular, said, you look like you're 70. You ought to do something about that. Well, that's kind of a mean thing to say. But, I take these things lightheartedly. And so I responded, well, I'm 83, so I think I'm doing pretty good. Well, apparently the commenter actually believed that I was 83 and then accused me of lying in the video when I said I was in my 50s. Can I pass as 83? Don't answer that. I don't want any answers to that question. Okay. So Marv started off the questions. He wants to know, you've explained why it is advantageous to include a bond index fund or bond ETF as part of a retiree's portfolio. Can you discuss why a person should have bond exposure during their working life, especially for a younger person? Um, and he also said he gave this video a thumbs up. So yeah, I mean, that's a good thing to do. Appreciate it. So as you know, my sort of go-to long-term portfolio is 90-10. But I've often said you certainly can have a 100% stock portfolio. I think what's more important than one of those portfolios versus another is, can you stick to it? That's the question. So if someone's 20 right now and they're dollar cost averaging into a 401k IRA taxable account, all of the above, and they're 100% stocks and they can stick with that until, let's say, I don't know, maybe they're 50 and they start to get more conservative or whatever age, depending on when they're going to retire. I think that's, a perfectly viable portfolio. The thing you have to remember, and this is really true with any portfolio, is that over fairly long periods of time, you'll underperform. Even a 100% stock portfolio over a decade or more can underperform a portfolio that, say, is 90-10. And I'll show you an example of that. Let me, I pulled this up on Portfolio Visualizer. And all I did was a 100% stock portfolio using US stock market. So that'd be like a VTI. And then 90-10 for the 10, I use total US bond market. And if we analyze this, this actually goes back to 1987. And as you would expect, the stock portfolio outperforms. I mean, not by as much as maybe you thought, but it outperforms. And we would expect that over, what is that, 40-year period or something? 35. But here's the thing, let's change the time period. Let's go from, we'll say, I don't know, 2000 to 2009 or 10. And you can see the portfolio with bonds actually outperformed. So and it's easy to, I think it's easy to look back in hindsight and think, well, that was just a small period of time and fine, get that, Rob, but long-term stocks outperform. And that's true, they do. But 10 years is a long time. There's a big difference between being 27 and 37, trust me. And so if you're putting that money into stocks and you're seeing them down 3 years in a row, as they were with the tech bubble, and then we have the Great Recession, you would have done really well had you just stuck to it. Now, we snap our fingers and we're in 2022 and your portfolio is doing great. And, who knows what the future will hold. I think we're down today. I think everything but my bank stocks are down. Yeah. So that's why I sort of prefer the 90-10, but it is a personal choice. It's not like one is right and the other is wrong. I think there are wrong choices. If you said, well, I'm going to be 80% bonds and 20% stocks as a 20-year-old saving for retirement, to me, that would be wrong. That's bad. But there's plenty of reasonable approaches. But that's my thinking. And I was just comfortable with 90-10 most of my accumulation years. Okay. Next one. Nicholas asked me my favorite local restaurant in Northern Virginia. I asked him what kind of food. I don't know if he's responded. But I'm not a big foodie, to be honest. In fact, my wife and I were thinking of where we might go tonight, and it's just going to end up being a pizza joint. We're not fancy. So I don't know that I have a favorite, which sounds kind of pathetic. I think I need a favorite. Carr says, did you hear the Talking Real Money guys suggested your Morningstar tutorial? Oh, so that's so nice. I did not know that. Are these the money guys, or I'm not sure what the Talking Money guys are, or Talking Real Money guys? Is this the same money guys that I know? I'm not sure. Oh, yeah, I'm not sure. No, different. Oh, very nice. I did not know that. Thanks for sharing that. Actually, I do plan another Morningstar video, and I've gotten a couple of emails about this where you can sort of print out this report from Morningstar on your portfolio. And it's got a ton of data. And so someone emailed me and said, could you walk through all of that and explain what it all means? So I've got that on my list. In fact, I hope to publish that next week. Okay, Wilma. I used to use an investment advisor. They use GNMA as part of their bond portfolio. What is the purpose of GNMAs in a portfolio like that? Well, and this is, I think, refers to Merriman's portfolio. I don't know what their thinking is. I think it's probably just a way to add some diversity to your bond portfolio. I mean, one thing I can tell you, and I've not done a deep dive on GNMA fixed income. I can tell you that if you use something like BND, Vanguard or Fidelity has one as well. I mean, this is just a total U.S. bond market fund. And you go to the portfolio, you see that it has securitized bonds. Basically, I think real estate backed is what that would be for the most part. And then, of course, corporate and government. The only thing it doesn't have that would be TIPS, right? I mean, that's not the only thing. Doesn't have municipal bonds, doesn't have international. But in terms of sort of the U.S. bond market, where you might think a little more diversity, you could add a separate fund for TIPS. I don't know that you would need any more than that. But they may have a reason for it, Wilma. I don't know that I could articulate that, other than it just may be their view of maybe further diversifying the bond portfolio. I'm trying to think of an example. Let's see. So Vanguard has a mortgage-backed securities ETF. I'll show it to you. VMBS. Yeah. So this is Vanguard's mortgage-backed securities ETF. You can see it's a intermediate term, and go to the portfolio. Yeah, and it's all down here in the securitized, well, most of it, except for the cash. And so, you could add some exposure that way, I suppose. But to me, if I'm going to make my portfolio more complex by adding another fund, I want to have a good reason to do it. For me personally, this would not be a good enough reason. But, your mileage may vary. All right. I've really hit on something in my own mind, this idea of complexity and a feeling of control. I really do think that some folks, and maybe we all do this to some extent, maybe I do this to some extent, but that if we make our portfolio a little more complex, rather than just, say, a 3-fund portfolio, for example, it gives us a greater feeling of control, that we have more input into the outcome. And some of us want that. Some of us really want it. I'm not sure that actually improves the outcome, my portfolio included, for that matter. All right. Punch King 123. For early retirement, say 55, what approach would you take to bridge to access retirement accounts? A taxable account, cash, target, 5-ish years worth of expenses, something else? Well, certainly, I mean, let's think about the time period until you're 55 and you're saving for retirement. You want to take as much advantage of the tax advantaged accounts as you can, right? 401ks, IRAs, possibly an HSA. But what kind of accounts, Roth versus traditional, it's going to depend on your income, right? And your tax brackets and your choices. So if you think about it, if you end up with a lot of money in, say, a Roth IRA, you can, if you want to, I'm not saying this is the best approach, but one approach would be pull out your contributions until you reach 59 and a half, where you can then take out from any of the accounts, at least without the penalty, right? If you have enough to max out your 401k and IRA and then add into taxable accounts, that would probably be my go-to approach, because you're going to get some amount of dividends and interest that you can live off on. And then, when you sell, you're getting the assuming long-term capital gains, you're getting a better tax rate, and you're only paying the tax on the gain portion of what you've sold. Another strategy would be, and I don't know that this would really help you. I guess you'd have to start it at 50, but this idea of Roth conversions, where you convert from a traditional to a Roth, say 1 year's worth of expenses when you're 50, you got to wait that 5-year period, right? And you got to make sure you don't get penalized if you start taking it out. But you can do that Roth convert. If you just Google Roth conversion ladder, let's see what comes up when we do that. Investopedia, choose FI. Mad Fientist has done a lot of work on this. Mad Fientist, I'll show you his site. He's got this article right here that I think has been pretty well received. I can't say that I've read it closely and vetted it or whatever, but I think it's generally been considered a pretty good approach to this question. So that would be a good resource maybe to check out. All right. Norma, thanks for joining. Glad you're here. Ken, welcome. Okay, Scott. Why place HSA dollars into investment vehicles rather than leaving in cash? Health is unpredictable. Therefore, in my opinion, no investment risk should ever be taken. Well, I see that. I see the point. If you think about a health event that's very expensive, we have health insurance and it's capped, right? Our out-of-pocket is capped. So I know, at least on an annual basis, what my maximum exposure is. Now I'm sitting here trying to think, okay, is there any sort of healthcare event? I guess if I needed long-term care, or my wife did, health insurance for the most part is not going to cover that. So I guess to answer your question, Scott, I think there is a trade-off and there is some risk, but I'm also looking at our overall financial picture and can we handle that risk with other assets? And so then is it worth taking risk inside the HSA versus keeping it in cash for what could be decades? And so that it's a trade-off. I agree with that. It's definitely a trade-off, and it's a trade-off you've got to be comfortable with. In fairness, as I think about our own portfolio, I mean, our HSA funds are pretty insignificant. I don't know, it's less than 1%. I don't know, because HSAs, we haven't had high deductible health plans for that long. So we haven't been contributing that, for that long period of time. There's obviously an annual cap on what you can contribute. Part of it, it might vary depending on your health and your history, your family history. I guess at some point it is, though. You're taking a risk one way or another. My question is always, if the worst case does happen, and so you think about it, a health event and the stock market crashes, how would we deal with that? Do we have ways to deal with that? I think we do. Also keep in mind that I am allocating across all of my accounts. So let's say it's 80-20, that the fact that I might be 100% in stocks inside an HSA and inside a Roth doesn't change the fact that when you look at all of the investments, they're still 80-20. So we have fixed income, and if the stock goes down, we're going to rebalance, which means buying more stocks or stock funds, which is what you want to do when it goes down. And so, and if I felt compelled to, I could just take out of the fixed income to cover a health event and save the receipts, right? And then pull out of the HSA years later when it recovers. I don't know. Hope that makes sense. Anyway, that's how I think about it. Dan, I am somewhat concerned about a weakening US dollar long-term over the next 1 to 2 decades. How would one hedge holding other currencies, including digital currencies, for safety's sake? Well, that's a tricky question in my view, because how do you hedge? I mean, and I'm not an expert on hedging. What a lot of people say is, they're going to use Bitcoin and other cryptos to hedge, against the government printing money, which of course can lead to a weakening US dollar, at least in theory. The problem is all the other governments are printing too, and we still seem to be the safe haven, but it's relative, right? It's like when you're with a friend and you want to outrun a bear, you don't actually have to be faster than the bear, you just have to run faster than your friend. It's kind of the same way with currencies. But people have said, Bitcoin, that's the hedge, but so far it's not worked out, right? It's not a hedge at all. It drops in fact, let's look at prices today. So the prices were up. Well, they're still up. They went up. They were down this morning. Of course, what's the market done? The market's come up from its lows this morning. It's interesting. I see Bitcoin is highly correlated to the S&P 500. I don't actually have the data on that. So, but that's what I've noticed. So, but a weakening dollar means inflation, right? And I think long-term hedges on inflation could either be inflation-linked bonds and honestly equities long-term. Short-term inflation can really hit stocks, but longer-term stocks have proven, to be a pretty good investment in inflationary times. I don't know how well they hedge against a weakening dollar. So I kind of feel like I've talked for 5 minutes and not answered your question. Um, yeah, I don't know. Let's see what Google says. How to hedge against a weakening US dollar. Here we go. Market Watch. Here's the best way to hedge the weakening US dollar, and buying gold isn't the move. So what is it? They don't tell you. They probably want to sell you something. They don't give an answer. Figures. So Prescott, I don't know. I just or not Prescott. Who asked that question? Dan asked the question. To me, the best answer is a diversified portfolio, low debt, keep your skills sharp. That's my approach. Prescott, I'm receiving a full government pension. Man, that would be nice. That will cover over 60% of my monthly expenses, and wanted to use the 3 or 4 fund portfolio. Do I still need a bond fund? You guys just don't like your bonds, do you? So, and I get it. With rising rates, particularly with US government bonds where there's no credit risk issue, the loss in value of the bonds is mathematical, right? It's a certainty. It happens. With stocks, they're going to lose value too when the prices, when interest rates go up, at least in the short term, right? But it's not a mathematical certainty. So even though stocks are sky high in terms of valuations, and we can just look at the Schiller PE, right? Let's check it out here. In case there's any doubts, there it is. We're at a near all-time high. Only the tech bubble was worse. We're well above Black Tuesday in 1929. Well above Black Monday in 1987, right? But for some reason we worry about the bond side of things. Certainly, here's how I think about pensions and even Social Security. Some folks will say, kind of calculate the present value, and you can allocate that to your bonds. And I'm not here to say that that's somehow a flawed, fundamentally bad approach. But it seems to me the question becomes, once you factor in your other sources of sort of guaranteed income, in your case, it's going to cover whatever 60+% of your expenses. You still need roughly 40% of your expenses. Let's assume your expenses are 100 grand a year, just to pick a number. So you still need 40 grand from your investments. So the question I would ask in this hypothetical, if I were in your situation, and I wish I were getting a government pension, is what percentage of my investments will I have to pull out, let's say in year 1, to get $40,000? If the answer is, well, that's 4% because I have $1 million invested, and 40 grand, 4%, what history tells us is if you're at 100% stocks, most years you'll do fine. And in fact, most years, most starting years, and then if you fast forward for a 30-year retirement, you'll end up dying with more money than you started with. Your $1 million will not only have not come down after 30 years when you go to that big mutual fund in the sky, your loved ones, your charities, whatever, will have more than $1 million, right? But the history also tells us, and this is all from Bengen's research and follow-on research, is that, however, there are a handful of years that if you'd have retired, particularly around 1929, stocks took such a beating that you'd run out of money. And that's why Bengen said, if you're following the 4% rule or something close to it, you should be at 50 to 75% stocks. And I don't think, in my mind, I don't think that's changed. Now, you could be saying, well, Rob, that's great, but I don't need 4%. Whatever you need out of your investments is only 2%. Well, if that's the case, again, based on history, I personally think 100% stock portfolio would be fine, because you only need 2%. If you want to run some sort of hypothetical scenarios, I still think, and we've looked at this site a couple of times over the last few weeks, I still think this would be the best site to look at. It's calculator.ficalc.app. And what I would do would be to model, I would personally, what I would do is I'd subtract my guaranteed incomes like pension. All right, I need whatever the remaining dollar amount is that I need. I'd put it right in here. Let's call it 40,000. Whatever length of retirement you need. We could put in here 100% equities and no bonds. And we'll assume no cash. Save that. And then constant dollar would be what you would use as your withdrawal strategy, assuming we're going to follow Bengen. And I would adjust it for inflation, right? And I'd put, in this hypothetical, I'll just say it's $1 million portfolio, taking out 40,000 a year, no additional income. Again, because I'm sort of excluding the pension. Another way to do it would be to add your pension in here and then increase what you need to take out by the amount of the pension. But you can do it either way, I guess. Historical data, by the way, I meant to show you guys this. Right now, it uses, it's checked, use all historical data. And so if you come down here, this is all the data. It goes all the way back to 1871. And you can see, by the way, that with 100% stock portfolio, it's interesting. The reason you might say, well, Rob, I thought you said 1929 was bad. It is red. It's a year you run out of money. But these are worse. And that's because we're adjusting for inflation. And inflation was terrible, as you older folks will recall. Although, did you see our inflation rating today, 7.5% year over year, worse since 1982. In any event, if we didn't adjust for inflation, the 60s looked just great. Right. And 1929 is really the only terrible year. But again, this is using historical data. And I think that's very useful because this is stuff that's happened in the past. So one would theorize it could happen again. But I also like running these numbers either through personal capital. New Retirement does this too. A Monte Carlo analysis, because that will show you, it'll simulate all kinds of different scenarios of market returns and inflation, including scenarios that have never happened before, some of which are probably unrealistic, but it can do like 5,000 of those scenarios, in a couple of seconds. And then it'll give you a percentage. What percentage of the time from however many scenarios it ran, did your portfolio survive? So I would use both tools, but I really like this one. And then I think you can click on here, yeah. And so like I'm looking at 66 to 96, and it kind of shows you your portfolio, which is useful because this one runs out of money. But like if we go back, how do I go back? Here we go. Let's pick one that doesn't run out of money, but it comes close. The yellow means the final portfolio was less than 35% of the initial portfolio. So in this case, it'd be less than 350,000. Click on this. Here, this is the tricky part. So this is considered a success because the money lasted 30 years. So in Bengen's analysis, this goes in the success column. But boy, it's going to take nerves of steel to live through this, because first of all, this all assumes you die right here, right? Well, life ain't that certain. What when you're here? You don't know if you're going to die. At that point, are you hoping you die in 2 years? I'm not quite sure, but the money is really low. Anyway, yeah, that's probably more than you all needed. But there you go. That's how I sort of think through these issues. I love that tool, by the way. Fun. David, good morning. Do you have a set schedule as to when you do your live? Yes, I do. Live shows. So they're Thursdays, 11 a.m. Eastern time. And I think I'm going to try to stick. I was going to go to an hour and a half on these shows Thursday, but I'm going to try to stick to 2 hours most days. And then I'm making Monday at 7 p.m. Eastern time sort of a regular as well. That one will be an hour and a half because that cuts into family time. And my wife has been gracious enough to allow that, at least for now. She has every right to change her mind, which she does from time to time. So yeah, that's the plan. There'll be some weeks when I miss, but Yeah, most of the time that's what we're going to do. So there you go. All right. Paul, if over half my spending needs per year will be met by commercial building rent income and the rest from Social Security, how high a percentage in equities do you think is best? Well, Paul, so if I understand your question, you don't need your investments at all to live on. Social Security is as guaranteed as anything in life can be. I know some of you will probably fall out of your chair when I say that. No, they're going to cancel Social Security. Well, I don't think they're going to cancel it for people that are receiving it now. I don't think they're going to cancel it for anybody. But in any event, I guess it's not a sure thing. Commercial building rents, I guess the question there would be, what are the risks associated with that? What's your leverage? How confident are you that those rents will keep coming in? What do you think they'll look like when we hit our next recession? What are the terms of the rental agreements? Do they expire soon? Or, maybe they're 10 years out, but when they expire, it's a space that's really hard to rent out again. At Tyson's Corner, which is a big super mall here in Northern Virginia, LL Bean. So Tyson's Corner is kind of a famous mall. It was the first place where Apple opened its first store about 20 years ago. It was the place where Microsoft opened its first store. And it was the place where LL Bean opened its first store outside of Maine. Apple is the only store remaining. Microsoft closed, LL Bean just closed. They had a 2-story section of the mall that's huge. Who knows how long it'll take the mall to fill that space? So those would be questions in my mind. And then what is your purpose with the investment side of it? Is your thinking, I'm not going to spend it? If your thinking is, I'm never going to touch it, I'm going to leave it to my children or to charities or both or whatever, I'd probably have, if I were in that situation and I was confident I would never have to touch it, I'd probably have an 80-20 or 90-10 portfolio. But I'd have to be awfully certain that those commercial rents are coming in like clockwork, or that I could still survive pretty well if they took a dive for a couple of years. Crazy man in the pink wig, welcome. You and Salty in the same show. That can only lead to good things. Good morning from New York. Hey, Matthew. All right. Whoops. Sometimes the chat jumps on me, meaning I'm looking at all your questions and then it just jumps to the bottom. Salty says Moby Dick's kebab carryout. I will say that is very tasty, and they're now in Northern Virginia. They weren't for a long time. They were just in DC. Okay, Jim, he didn't tag me, but I think this is a question. If a 20-year-old did 80-20 bonds to stocks, they would be in 100% stocks in their 50s. I guess if they didn't rebalance, that's would their bonds really go to zero? I don't know. Okay, Mike says, love the show. We have a Schwab pledge asset line. It's called a PAL, P-A-L, pledged asset line, which we use to buy our home. Really? Okay. It's a 2% interest-only loan. Why would we ever pay it off as long as the market beats the percentage? So my first question to you, is that tax deductible? I guess, I don't know how that would work, because they don't take a mortgage on your property. It's secured by the assets in your account. Of course, you may say, well, it's a 2%, so that's better than a 3.5% mortgage. I don't even know what rates are today. The problem is, so PAL, it's 2%. Actually, I think I've seen it as low as 1.9 at Schwab. Let's look at mortgage rates. Mortgage rates today, what are they? Oh, they've definitely gone up. According to the Google machine, here, I'll just pull up. We'll just go to NerdWallet. I hate that NerdWallet ranks first for about everything. Google is not doing their job. Anyway, 30-year fixed rate. So you know the difference. So this is the rate, but the APR factors in fees, right? So the APR is what you would want to compare, when you're comparing different rates. In any event, yeah, power rates will definitely be going up. Remember, I predict what or when, but never both. They're going up. That's my prediction. I just don't know when. And I'm sure they're still at 1.9. That's like the lowest. Depends how much money you have at Schwab. Let's see here. Yeah. And it's actually the spread. Here's the index. It's 190. If you have 2.5 million at Schwab. But the problem is this can go up, and it will go up. That would be my biggest concern with that approach. Now, I suppose you could say, well, it might go up, but my investments will always outperform it. Well, I'm just not a big believer in investing on margin. I guess you could say, well, if I just took out a regular mortgage, it's kind of the same thing, I suppose. But this is one in which you never pay off the principal balance. I'm just too conservative for that kind of thing. It's just not how I would approach it. I can't say it won't pay off for you, but yeah, that would not be my approach. Benny, love the channel. Any thoughts on opening a non-deductible traditional IRA if I'm not eligible for a Roth IRA? Am I better off just using a brokerage account? Well, if you can do a bunch of IRAs that are deductible, meaning they're pre-tax, like for example, you roll over a 401k to an IRA, and it's they're going to factor that in and take a pro rata between what's taxable and what's not. But like if you just open up, if you have no IRAs and you put in $6,000, you can't contribute to a Roth because your income, you can't or don't want to take the deduction. You put it into a traditional IRA, convert it to a Roth. I think that's a great approach. If it's just between, if you're not going to get the deduction, maybe because you don't qualify, and you can't do a Roth conversion, or it wouldn't be useful because maybe other IRAs. I'd probably just go with taxable. And my thinking is my taxable investments are going to be very, very efficient. Yeah, they'll pay a little bit in dividends, but that's it each year. And I'll get capital gains tax at the end. But because I'm not getting that deduction or converting it to a Roth, I think I'd probably go with taxable. That's just off the top of my head. Yeah. If I did some real analysis, I don't think I would change my mind. Maybe one of you guys can tell me why that would be wrong. And it could be. Conan. I got interested in Schiller, so started looking for his latest writings. Found an article about excess CAPE, cyclically adjusted PE, I think, yield, and wonder what you think about it for assessing current equity valuations. I haven't read an article about excess CAPE yield, so I don't have an answer. Excess CAPE yield. Oh, let's figure it out. All right. Yeah, cyclically adjusted PE for the S&P 500 is often used to illustrate the excessive valuations of equities, especially recently. However, CAPE does not control for the increasing importance of the level of interest rates for valuations. And so the idea is to say, let's go back to that chart I showed you here. So I think the point that's being made in that article, and I could be wrong, is that it's not really, you can't just compare, say, this level to this level to this level. You've got to factor in the prevailing interest rates at each of those points in time, because interest rates affect valuations. And what could be a reasonable valuation at, say, a 10-year yield of 2% would be very different in an environment where the 10-year, and you could pick 30 or whatever, but the 10-year yield was 5%. Okay, I think that's the point it's making. The excess CAPE yield does so by taking the inverse of the CAPE, profits paid for each invested dollar, minus the inflation-adjusted 10-year treasury yield. Effectively, the ECY reflects the yield margin that investors demand to hold stocks instead of bonds. Okay, that kind of makes sense to me. And here it is. This is from when? What's the date of this article? Oh, just a couple of months ago. Well, I'm going to have to wrap my mind around that. And I will do that. And I will bring it up again, if I don't forget, on Monday. That's interesting. Akeem, would you sell all your VTIP for BND or divide the fund equally between them both? Well, I don't know about selling VTIP. I'm not going to get out of tips. The question that I've been ruminating, thinking about, I've mentioned in the past sort of 50-50, and that kind of makes sense to me. That was David Swinson's approach. He was, ran the Yale endowment. I think I mentioned an article to you guys a week or so ago that one guy looked at the data and suggested maybe just 20% of your bond portfolio on tips. When I looked at this. I don't know that this is at all useful, but I'll show you anyway. So we're back to Portfolio Visualizer. So I did this exercise, in fact, this morning, as I was thinking through this issue. So we'll put 100% in the bond market and 100% in tips, and we'll run this portfolio. And it goes back to 2001. I think they came out in 97, but I could be wrong. Why is this so? Oh, wait a minute. I got to change the dates. Well, that's not going to change the starting date, but it'll definitely change the ending date. All right, so we're the last 2 decades, right? And when we look at the performance, I was surprised to see tips outperform the total U.S. bond market by, I think, a fairly notable margin. They were a little more volatile. When we look at the max drawdown for bond fund. And then if you go to the individual years, red would be tips. And it's some pretty sizable outperformance here, and then through the Great Recession, and even look at the last 2 years. So I was kind of surprised to see that. But given this performance, I don't really follow the one article that says just 20%. So I still think I'm probably in the 50-50 range personally, but it's something I'm still thinking about. Okay, Mostly Harmless 314 says, thoughts on a 20-year-old modifying a 3-fund portfolio to include more higher risk, higher reward allocation, overweighting small cap value in emerging markets. I think it's a great approach, and it's the one I took. So of course I think it's a great approach. It's still the one I take. Yeah. The key is whatever you do, just stick with it, right? So my approach was to take, like, if I'm going to have, let's say, 25% in VXUS as an example, international fund, I would carve out 10% of that and put it in emerging markets. And if I were going to have whatever, 50% in VTI, total US stock market, I'd carve out 10%, put it in small cap or small cap value. Was how I did it. And how I do it, I have 10% allocation to small cap and emerging markets. And REITs, but that's a different kind of thing. Yeah, I mean, it's the approach I took. I don't know if that means you should follow it or run from it. I am 83 after all. My age actually doesn't bother me, but in listening to myself, it sounds like I'm very sensitive to that fact. I think it was the fact that he basically called me a liar, and that toasted my buns. It's okay. I don't think he'll be back. Philip, you mentioned you're a bit worried about the possibility of one company being hacked. Could you do a video of how to transfer your portfolio to other brokerages without triggering taxes? Philip, I can do it now. It's super easy. And I've just completed that whole process myself. So let's say you want to transfer from, I don't know, Schwab to Fidelity, just making it up, doesn't really matter. With some exceptions I'll talk about, you can simply, what they call it, transferring the assets in kind. So there, if you own 100 shares of VTI, they just say, okay, those 100 shares now are over at Fidelity. So the way I would do it is I would call the broker that I want to send them to begin with. And they'll walk you through it because, of course, they have a vested interest, right? They want to get your money. So, and it's really simple. I'll be honest with you. I mean, I've invested for a fair amount of time. It's nerve-wracking. I get a little, where's my money going? What's happening? Yeah, I get a little nervous over it, but you want to transfer them in kind. One of the things that could come up if you own shares of mutual funds as opposed to ETFs or stocks, it's at least possible that the broker you want to send them to can't accept them in kind. It's possible. Now, if you're at Vanguard, depending on the fund, you might be able to convert it to an ETF first without any tax consequences. Again, you want to confirm that with Vanguard before you actually do it. But that has sort of two benefits, potentially. One is if you're dealing with the inability to transfer mutual fund shares, some mutual funds you can transfer. So, I don't know why you can transfer some and why you can't, but you can talk to the brokerages and find out. But the other advantage is if you're transferring out of Vanguard, I don't know why I'm using this as an example, but I guess because you can convert the mutual funds to ETFs, and you want to convert to ETFs, it's better to do it while you're still at Vanguard and then transfer the ETFs in kind out. Because if you transfer the mutual funds to whatever, Schwab or Fidelity or Interactive Brokers or whatever, and then you convert, one, you could pay a fee. Two, they're not going to probably be able to convert fractional shares. It just gets more complicated. But Philip, yeah, you can generally transfer assets in kind. And you just confirm with the brokers involved that that's what's going to happen. I just did it with a couple of different brokers and didn't have any issues. Sean, opinions of VIPSX versus VBTLX. So what? One's a tip and one's just total bond, right? For the lower risk section of your portfolio. Well, let's just make sure I know what I'm talking about, or at least barring that, at least understand what these tickers are. So VIPSX, right? That's inflation protected securities. That's TIPS fund. And then we'll open up another tab and type in, this is, I'm sure, is the BND, right? Just the just the mutual fund version of BND. And so if we go to portfolios, we can see, whoops, don't want to go to people, want to go to portfolios. So here's the TIPS fund. So it's an intermediate term. We know that because of the duration, 7.5 years, but this style box also tells us, right? So what that means is the low, medium, high deals with credit quality, meaning the risk of default. So the credit quality here is high, meaning the risk of default is very low. And that's because they're all US government bonds. Limited, moderate, and extensive refers to interest rate risk, which, as we know, as interest rates go up, existing bond values go down. The risk to this fund of rates going up is moderate, which is just another way of saying it's an intermediate term bond fund. If it were of shorter duration, let's say 2 years, this square here would be lit up. I don't know how well you can see that on the screen. I'm moving the cursor. I don't know if that helps. And if this were longer, let's say it had a duration of 20 years, then the interest rate risk would be extensive. I don't know if that's extensive or extended, probably extensive. In any event, you get the idea. Total bond fund should be, let's think, should be the same, right? Should be this, I think, yeah, it should be that same square lit up. Yeah. Slightly shorter duration, but very similar. And so these funds I think are both good. This is what we kind of just talked about, Sean, where I'm kind of the view of I would put 50% of my bond portfolio in one and 50% in the other. The basic idea is if interest rates and if inflation ends up being higher than the market thinks it is, TIPS will pay off nicely. If inflation ends up being lower than the market thinks, the bond fund, you could think of this as like a nominal bond fund, meaning it's not linked to inflation, would do better. And if inflation is exactly how the market thinks it's going to be, then it's basically a wash over time. And so it's that reason that I would probably, think 50-50 is a good way to go. I suppose long term, if you look at these funds over a long period of time, you'd probably find you could do just fine in just one fund. I would, if I had to pick one, I think I'd probably pick this bond fund, just because it's got a little more diversity in the types of bonds. But we just looked at this, right? We just looked at this here, and the TIPS actually outperformed. Now we weren't looking at those specific funds because they don't go back as far. This gives us more data, but we can. Let's check it out. So VIPSX, there it is. This is portfolio 1. And then VBTLX is portfolio 2. How far back does it go? That goes back 20 years. So basically the same, roughly the same time period. Maybe that is the same time period. Well, this will be interesting. So I'm kind of surprised they go back that far. Yeah, inflation beat it out. I don't know what you want to draw from that, but I mean, the next 20 years, for all we know, total bond will outperform. That's kind of why I kind of like the 50-50 approach. Anyway, there you go. Benny. Oh, he's asking Mike a question. Sorry. Philip said yeah. Yeah, okay. Yeah, Philip was just saying the question about transferring funds was in a taxable account. Sure. So yeah, you can transfer in kind. Ethan. If I am an index maximalist, would that be index maximalist prime? Is this a Transformers question? Okay, I'll just read the question. I don't know where we're going here. If I am an index maximalist and I want the equity portion of my portfolio to perfectly match the market, where should I look for the data and what funds to invest in? That's a great question, actually. I like that question. So my first answer is you can't even possibly come close to matching the market. If by market you mean all equity, right? Because why? Most of it's private, right? My business is not traded publicly. You can't invest in my business or the laundromat down the street or most restaurants. And that's true across the world. But I know what you're saying, Rob. Okay, fine. You're being a smart aleck. We know that, fine. I just want the public markets. Well, if you're going to invest in the public markets, I guess the first place I would start is it's probably a fund like VT. What I don't know, I'll show you the fund. This is just a Vanguard Total World Stock Market Fund. Here it is. It's 60% US, 40% non-US. We can look at the weights. It's got large, small, medium. What I don't know, let's take a look. Public stock markets by country. What's that get us? Public stock market value by country. What's this tell us? So, well, this is Wikipedia, so this got to be correct. Our total market cap is in millions. So that's what, 40 trillion, I guess? Yeah, 40 trillion. Do you have a total? Let's see. They don't total it. So my point is that 60%? Could that possibly be 60%? It could. 12, 18, 24, 27, 29, 31, 33, 4. No, it couldn't be. Nope. So I don't know if there's a better fund, but it's tough. So what you might end up having to do is and a friend of mine did this, actually, now that I think about it. I've mentioned him in the past. He's got this massive spreadsheet with like 18 or 20 different ETFs because he's trying to do what you've just suggested. But to do that, he's got to get country-specific ETFs. It gets very difficult, of course, and it can get expensive. Country ETFs can be more expensive, but you might try it that way. If you wanted a simple solution, VT is the best I know, but it's clearly not perfect. That is to say, if Wikipedia is at all accurate, which kind of sounds stupid as those words come out of my mouth, but whatever. RAM. My personal opinion is if an advisor's fee structure is AUM, that means assets under management, meaning if you give them $1 million to invest and it's 1%, you'll pay 10 grand for that year. And then next year you'll pay 1% of whatever the value of your funds are that year. that person should not claim a fiduciary. Please discuss for the sake of improving the industry. Yeah, it's a good point. So a fiduciary, so you think about there's fiduciary and non-fiduciaries. So if you go to someone who's a fiduciary, they'll often say we're fee only. What that means is they have to put you into investments that are in your best interest. Now that sounds good, and it is good. And if we go out of that for a minute and go to someone who's not a fiduciary, this is someone who would put you, say, into A shares, which are shares with load fees, like from American funds, where the fund pays the advisor, right? So with a lot of A shares, you're paying what's called a sales charge or a load fee of 5.75%. So for every dollar you invest in an American fund, mutual fund, 5.75 cents comes out in expenses, and some of that gets paid to your advisor, right? So for those folks, they still have to meet a standard. It's just not a fiduciary standard. The standard they have to meet is called suitability. The investments they put you in have to be suitable to you, which is a lower standard. The problem, and this is what Ram is getting to, is that while fiduciaries have to put you into investments that are, have to consider your best interest in putting you into investments, that doesn't mean they have to be cheap, which sounds kind of crazy. It's like, well, wait a minute. How can a very expensive mutual fund, along with a very expensive fiduciary, be in my best interest? Good question, but that's just how the industry works. So you could get charged an arm and a leg. I've seen well-known firms that charge 1.75%. That's just the advisor fee. It's perfectly legit under the law, and it shouldn't be. That's why I was listening to a Fisher Investment advertisement. We're fiduciaries. Like, yeah, well, why don't you tell everyone how much you cost? That's the other thing. You want to know if you've got a good advisor? Go to their website. I'll show you an example. Here we go. Here's Fisher Investments. I don't know why I'm picking on them. Now, the goal is to figure out how much they cost. So normally I'd start up here and go to fees, but I don't see anything. About us. Fees. Oh, great. That was easy. All right. I challenge you to read this and tell me what they cost. I've looked at this. You can't. It's not there. Let me give you a different one. I have no affiliation with any of these companies that I'm showing you. Here's Asset Builder. This is I think they're a registered investment advisor. Pretty sure they are. And we got fees, fine. Here we go. They tell you exactly what it is. Our fees are based on assets under management and range from a maximum of 45 basis points annually down to 20 basis points, depending on the size of the account. The average fee is 35 basis points. That's what you want to see. And if you can't find that, that tells you there's a good reason why they don't want you to know that. I've yet to see a low fee advisor hide the fact that their fees are low. Okay. Aaron, could you take a look at SCHY? It's the international equivalent of SCHD. I didn't know that. SCHY. So a quick sort of aside. I really like SCHD, and I need to allocate a little more into my U.S. stocks. The thing holding me back is complexity. If I'd be perfectly comfortable putting some of my U.S. stock allocation into SCHD, which is a Schwab. I would call it a value fund, but some would call it a dividend fund, but whatever. But now it's just another fund that has to be juggled, and that's what's holding me back. But in any event, SCHY, here it is. So same kind of thing. If we go to the portfolio, we're going to see, I assume, a value fund. Yeah. So the dot is here. We can go to the weights and look at it. So the price to earnings, much lower than the U.S. Of course, that's true. Like if we were to look at like VXUS, which is just a total international stock fund. It's going to be a blend, I assume. Yeah, blend. That's what BLD stands for. It's got slightly higher priced earnings, not significantly higher. But I think this is probably a really good fund. I've not studied it before. I'm sure its costs are low. 14 basis points. What's Vanguard's? 8. So they're both inexpensive. But yeah, if you want to tilt towards, so it depends why you're doing it. Some say, oh, I'm going to do it because I want the dividends. SEC yield is 3.88. Vanguard's, they don't have it. I don't know why, but 3.18 over the last 12 months. The SEC would be like over the last 30 days. But I would be more interested in it because of the value aspect than the yield. For me, that's just my approach. But it looks to me like a pretty good fund. So Kim wants to know if I have long-term care insurance. I do not. So the trick with long-term care insurance is if you don't have, and when you talk about how much money someone has, I always say a lot or little. What does that mean? Well, some would say you need long-term care insurance if you don't have a lot of money. Eventually, you just rely on Medicare. And if you don't have a lot of money, long-term care insurance just is too expensive anyway. And you could just deplete your funds if you had an event and rely on Medicare. If you have enough to self-insure, that's the better approach because long-term care insurance is expensive. It's in that middle range that long-term care insurance might make sense. And let me see if I can, I've read in the past articles. I'm just seeing if I can find one for you quickly. Well, you can, I don't know if this is going to prove helpful. I just Googled at what net worth does long-term care insurance make sense. This gives you some statistics on it, but I don't know how helpful that is. You really need to run some numbers. One of the things, I will show you this. See if I can log into my demo account of New Retirement. Bear with me. I got to sign out of my actual account and sign into my demo account, just in case my mother-in-law is watching. So, yeah, this is my demo account. And so New Retirement is, I think, probably the most robust financial planning tool, particularly for retirement, outside of tools that only advisors can get access to. And actually, it may compete quite well with those as well, like think a Money Guide Pro or an eMoney Advisor. And one of the things you can do here, so first of all, you can model expenses, right? So you can model Medicare premiums and all of that. So for example, if I open this up, I'll just say no. You can pick what kind of Medicare you're going to get. So let's say we're going to get Medicare with a gap policy. We'll just say medium for the moment. No non-smoking. We'll assume we have no. Whoops. Oh, I didn't mean to do that. That's okay. We got a spouse in this scenario. It'll model the costs. By the way, the numbers get massive, right, over years. But they have a long-term care checklist. And this can be useful. There's a lot of resources. And you have different approaches. So you can model different approaches, including for you could put in here, you could get a quote on long-term care insurance and then model that in New Retirement, that those premiums and how that's going to affect your cash flow and everything. But you can see, you can all the different options. You have a policy, you plan to get a policy, you plan to use home equity to fund the costs. There's different options here. So that can be a useful tool, I think. Yeah. One thing I would say is, if I were going to get long-term care insurance, I would try to self-insure as much as possible So you have this period, like how long do you have to be, do you need long-term care before the insurance kicks in? The longer that period, the cheaper the insurance is going to be, and how long does it last? And you can model different things. Mike says, would complexities become moot? And he means complexity in a portfolio with fintech innovation like M1 Finance's slices. I think M1 Finance helps with the complexity because, particularly in a retirement account, you can just hit a button and it rebalances for you. And so I definitely think it helps. But I don't have, I have an M1 Finance account for our credit card rewards. Yeah, so it could help. Yeah, it could help. I kind of wish all the brokerages would just get similar technology and make it free. Ethan, you said in one of your recent videos that a 50-year timeline for retirement, he's referring to, you would use a sub 3 withdrawal rate. I thought I said 3% withdrawal rate. Maybe I said sub 3. That seems extremely conservative. Big Earn would say 3.25% is good forever. Now, so Big Earn, we gotta make sure we're all on the same page. He's a tall guy, and this is his website. He's done a ton of work on the 4% rule. Does he have links to it somewhere? I don't know. If you Google him and 4%, you'll find a ton of work. There's also an interesting site. You could look at like permanent withdrawal rate. In other words, what's the highest withdrawal rate you could take by which over time the value of investments, even on an inflation adjusted basis, would never go down? And let's see, this is not the site I want. I'm going to show you a site that you can check out. Here it is. Portfolio Charts does a lot of work on this. And they have cool charts. And you'll see here, that's what PWR is. So what they've said is over a 30-year period, you could basically take out 3.4% in year one, adjust for inflation, and the value of your assets would never go down on an inflation-adjusted basis. Of course, in shorter time periods, that doesn't work out. And you can see over shorter time periods, I don't know if can I drag this? Whoops, no. But over shorter time periods, the withdrawal rate is a lot lower. But once it gets to around just over 3, at least, out 40 years, it works. And so I hear that. Yeah, I don't argue with that, Ethan. I'd probably still, but from a planning purpose and from I'm going to quit my job and never work again and never earn another dime, I don't know that I would push it all the way to that line. I might raise it over time as I move through retirement. But to quit my job and never go back, I'd probably want to be at 3% for me. Okay. Here it is. I don't know if I'm pronouncing that right. I have Fidelity for my 401k and Roth. I like M1 Finance and would like to buy Vanguard ETFs. Should I have a taxable account with M1 or stay with Fidelity and have everything in one place? Well, there are a couple issues there. Obviously, if it's all at Fidelity, it's all in one place, there's a convenience factor. A flip side to that is I kind of like to have my money on multiple platforms just from a security perspective. Not that I think, there's going to be a hack that takes all of Fidelity's money or M1's or pick your broker, but it just kind of seems like a smart thing in my mind to do. Now, when I was in my 20s or 30s, that's not how I thought about it, but I didn't have as much money. But I kind of like that idea of spreading the money out over a couple of brokers. And one of the sort of dividing lines for me is retirement accounts versus taxable accounts. It just is convenient. It makes, and when I get to the RMD age, all of my retirement accounts are in one place. We can calculate it. It's done. If I'm going to do any conversions, it's all right there. It's easy to do. That kind of makes sense to me. So, it's really it really comes down to a question of how important is just the convenience of one broker for you versus maybe you want to have some inconvenience for some security. And, if you like what M1 offers, then putting your taxable account there while keeping your retirement accounts at Fidelity makes a lot of sense to me. So it's a pros and cons thing. There's no one right answer in my view. Super Zig. How should investors go about factoring in geopolitical events into their long-term strategies? I really don't think they should, because I don't think it's possible to do it in any reasonably accurate way. I mean, I think it's hard to predict what's going to happen in Ukraine over the next week, let alone the geopolitical dynamics for long-term investing. So that's why I think the way you factor it in is through a well-diversified portfolio. That's my approach. I'm not going to invest based on my guess of what China or India will be like 25 years from now, which is one of the reasons, by the way, I'm not in the camp that says U.S. total stock market and you're done. I like international exposure, even though obviously U.S. companies do business all over the world. I get that. So that's my view. Just making sure no one was texting me to say, Rob, you're breaking up. The video's terrible. So Evan wants to know, do you have any opinions on closed-end funds? So I've never invested in them. And let's see if we can, he gave me some examples. So let's take a look at one. Oh, these are PIMCO funds. PIMCO Dynamic Income. It might be worth checking out. Here it is. Doesn't tell you much about it. Let me go to their site and pull it up there. PIMCO PDI. So here it is. Yeah, I'll have to probably do more research on these funds. I've just never really focused on closed-end funds at all. So I don't, I'd love to give you my opinion. I have opinion about just about everything, but not really this. So, I mean, the big difference, by the way, so with an open-ended fund, new shares can be issued, right, as more money flows in. Closed-end fund, they have a set number of shares that get issued. Those shares can be traded publicly, but it's closed, if you will, to issuing new shares. So there can be some benefits to that. I don't know. One question would be what the liquidity of these funds are, which I don't know. But I will. So now I've got two things. I got two pieces of homework. I'll work on that because that's a good question. Yellow. I felt really comfortable during the March 2020 downturn. Is that a good metric for how I would react in future market fluctuations during withdrawal periods of my life? Well, I can't speak for you. I can tell you that going through a bear market is very different when you're in retirement. When 2020 hit, I was not pulling from our investments, but I thought actually a better example for me would be the end of 2018. Didn't fall as much, but that's when I thought, yeah, I'll probably be pulling from my investments soon. And it's a little nerve-wracking, even if you're well below 4%. Now, I didn't, change my asset allocation. I didn't get out. So in that sense, I came through it, and for that matter, the 2020 COVID crash, with a good deal of confidence that I'm fine. I can weather these markets. Now, it could be different. Think about really going through 2001, the 2001, 2, and 3, or 2001, 2, and 2, but the 3 years after the tech bubble crash. That's honestly harder to live through than 2020. I mean, because 2020 went down and it was scary for a month, but then it quickly corrected, and then we see what it's done since then. When you're in retirement and you're in your third year of double-digit losses, I mean, it's like you want to throw in the towel. It's like, that's the great thing about chess. You can just resign, right? It's like, you want to throw in the white towel in a boxing match. I have this great memory. My sister was into martial arts and a bit of a kickboxer. And she was like in high school. She was like 17. And she went to this bar. I mean, my mom and I were there, brother, wife, to fight. And she's fighting this, adult, woman, I don't know, 5 years older than she is. And I'm scared to death for her. And they get into the ring, and I mean, there's, this was, there was a ref there. I mean, there was a real ring, but, it's some bar in Central Ohio. And there, and my sister does this round thing kick, and clocked her right in the face. Down she went, folded like a lawn chair, and I see her trainer heave the white towel. I just remember it falling in slow motion. And I was just thrilled that my sister didn't die. What were we talking about? What is this? Where am I? Yeah, so living through it for 3 years, double-digit losses while you're in retirement, that's not easy. So your risk tolerance does change, I think, or mine did, when I entered retirement, but I was still able to hold on so far, right? Who knows what tomorrow will hold. But it is nerve-wracking. Conan, you mentioned that you include real estate in your net worth. That's true. Do you adjust your portfolio allocation based on it? I do not. And I didn't adjust my allocation when I actually owned rental properties. Now, it would have been relatively small allocation anyway. I might change my allocation if I were a big-time real estate investor. But I have not. Salty just said inflation in all caps, so he's yelling, with about 37 exclamation points after it. Okay, Vinyl. The adjustments for inflation in 2023 are going to be huge. IRS tax brackets, Social Security, IRMA, about 401k and IRA contribution limits. How about the I-bonds? I wonder what the rate's going to be when it adjusts. Jim, you still buy and hold on your 3-fund portfolio article, or would you consider a 4-fund with total U.S. stock market split into large and small cap to be an active buy and hold? No, I don't consider that active. No, I wouldn't. I mean, I generally have sort of 6 asset classes, and I don't think that's active. I suppose one could argue that it's more active than just holding a core 3-fund portfolio, but in my mind, not much. I guess to some degree, it's degrees to some extent, but still, if you imagine active, day trader versus passive, I mean, even a 6-fund portfolio is pretty close to passive in my mind. All right. Wait a minute. Someone's commenting about my hair. What? And then it jumped down on me. Where'd it go? Did I lose it? Come on. You guys are talking about my age now. Thanks, TT, about my age. Yes, what does my age matter? Maybe I know a thing or two. But I for some reason, it's not letting me go above. I can't see all the chat now. I don't know. It's like, what is YouTube doing to me? Yeah, it won't let me see all of the live chat, which is ridiculous. All right, well, I missed the hair comment. So, and I may have skipped some of your questions. I'm sorry. Stupid YouTube. Okay. Vivek? I don't know. What is a good way to diversify from a highly appreciated single stock? Think Amazon bought at 60. I think a yacht. I mean, why not? And I think you should invite us all on for a big party. Well, I mean, you got to manage the tax consequences of selling, and there may not be much you can do. Just depends on your circumstances. That's the issue. Beyond that, it's sell and diversify, right? I mean, you could spread it out over a couple of years if that's going to help your tax situation. If you give to charity, I would give appreciated stock to charity. That's what we do, but that's not your question. I mean, at some point, paying taxes is a sign you've done very well, right? It's part of the bargain. I get a lot of questions about how to deal with selling appreciated investments. I mean, there obviously, if 1 year you have some asset that's lost money and you realize that loss, it can offset your gains. Maybe you can spread the loss over a couple of years, and that might help. It might not, depending on your tax situation. But at the end of the day, sometimes there's just not any easy answers. I'm sorry to say, but it's a good problem to have. All right. I'm still aggravated that I've seemed to have been blocked out of. What if we do this? Will this help me? No, it's like Google has just decided you can't see everything. Not Google, YouTube. It's the same thing, but drives me nuts. All right. Next question. Bob says, I've invested in VHT and VNQ. I've been invested in XLE and XLF. What is your opinion on tilting a portfolio, 10% or less, with a sector ETF or mutual fund? So here's the problem I have with it. I can't say that it's a bad idea necessarily, but I like to tilt my portfolio in ways that I can say to myself, okay, I'm going to tilt it this way and I can leave it there for 30 years. So to me, emerging markets, small cap value fit that category. I suppose one could say, like I think today, maybe a financials ETF or maybe energy ETF might, if you're thinking about a value play, might be worth considering. But is it the kind of thing that you're going to be comfortable with keeping for the next 20 or 30 years? And the reason that's important to me, well, one is simplicity. I kind of go back to that. But the second one is, if you're going to be buying and selling into sectors, even if you hold them for years, you've still got to now deal with the question of when do I get in and when do I get out? And I try to avoid having to answer that as much as possible. So I've personally never tilted my portfolio to a specific sector for largely that reason. Now, in my stock portfolio, where in theory I might have to sell, right, and think about valuations, I've thought about putting a sector ETF in there. I haven't done that. I wouldn't rule it out, but it wouldn't be part of my overall asset allocation. I almost treat that investment no differently than an investment in an individual stock. At least that's how I think about it. Maybe I'm just kidding myself. All right. If you can tell that I've skipped over your question, feel free to add it again because I can only go up so far in the chat. Akeem, which of Google tickers is having the stock split? Well, I assume it's GOOG. I know they have different share classes. What is GOOGL is what? Is that H class A? That's a good question. Oh, wait a minute. I think it's all of them. Alphabet intends to split the Class A, Class B, and Class C shares of the stock. There you go. That's according to CNBC, and they can't be wrong. I mentioned that some, the financial, Wall Street they profit off of active trading and complexity. So do like CNBC. Think about if we were all index fund investors, they would be out of business, right? Because who would listen? I listen for the entertainment value, and I like Squawk Box just because I'm usually up then doing something, put it on YouTube, TV on my monitor here, and it's like background noise, but they're kind of funny. I like the three of them. But, I mean, people will sometimes criticize Jim Cramer because he builds up a stock that then ends up not performing well. But I'm thinking, I mean, it's entertainment. I mean, are people really listening to him and investing based on what he says? I don't know. And it's not that he's not a smart guy, but I mean, he rattles off dozens of companies every single day. Anyway, Flighter, I don't know. I have a 401k and contributed both pre and after tax amounts. If I move to Vanguard, is it a concern that the segregation of pre and after tax is preserved? Do I need multiple accounts? Well, it will definitely be preserved one way or another. It's got to be. Whether it's multiple accounts, I don't know. It could be one account with with some sort of basis. It's a great question. I've never dealt with that personally, so I don't know, but Vanguard can absolutely answer your question. Ethan, do you use a trust for estate planning? Yes. Your guy, Mark Kohler, I'm not sure he's my guy, but whatever. By the way, he and I have never spoken. I just find him entertaining, and it seems to me he's a pretty smart guy on YouTube. Recommends revocable or revocable, if you prefer, revocable living trusts for everyone. Yeah, I mean, I don't know that I would go so far as to say everyone. And I know he uses them in part so like you can keep, some things secret, like where you live or something. I don't know that everyone needs them, but they can be a very important estate planning tool. Absolutely. So in there, you just need to talk to a trust and estates lawyer, which I am not. I paid a lawyer to prepare ours. All right. I'd love to see a Rob Berger endorsed HSA tracker. I'm not sure what HSA tracker is. I can tell you the two. I like Fidelity. I can tell you where I keep my HSA. I like Fidelity, no fees, and virtually unlimited investment options, and you can invest 100% of what's in your HSA. There's no requirement that you keep some of it in cash. I think Lively is pretty good. Lively. There's one that's like, is it the HSA Authority? They have some really good, I think, investment options, including dimensional fund advisor funds and Vanguard. The reason I wouldn't use them is they charge a fee. And it's not huge, but it's like 25 basis points, I think. Trying to look it up. I don't know. But I wouldn't, why pay a fee? I can't find it, but I'm pretty sure they charge a fee. But I'm not sure what you mean by an HSA. Do you mean like tracking your investments? Because I mean, I track all our HSAs in personal capital. You can connect your HSA accounts to personal capital. Maybe that's what you meant. Not sure. Okay. Beyond the underlying index and price, what else is there to evaluate for an index fund? Well, as we know, if it's going to be in a taxable account, you want to evaluate its tax efficiency. So we've looked at this, but I'll show you guys again, just in case. We'll use, what we're going to do? We're going to use a different, let's put in Schwab there we go. Let's look at, well, that's going to, is that I want the mutual fund version. Here it is. Mutual fund. Yeah, so remember, mutual funds are 5 tickers. There may be some exceptions to that, but everyone I've looked at is 5 tickers. An ETF is 3 or 4 tickers, or 2 in some cases, like VT. But so this, you'd say, okay, this is an index fund, so it should be really tax efficient. But when we go to performance, it's not terrible. But you can see they distribute some capital gains this year, and that wasn't a lot. So pretty efficient. They didn't distribute any that year. The green is income, so basically dividends, and you're going to expect that, right? Because the S&P 500 pays dividends. So if it's in a taxable account, I would look at that. But beyond that, you're looking at what index does it track and its fees. I suppose some funds might track an index a little better than others, but it's going to be, I would think, nominal. Let's put this in. Let me copy this. Come over here to Portfolio Visualizer. Let's see if it copied. It did. Okay. So we're going to compare that to VTSAX, right? So these should be basically identical other than fees. What's Schwab's fee? Yeah, that's less expensive, right? Because that's 2 bips. And VTSX, I think, is 4, isn't it? Yeah, 4. All right, so let's compare these two. How far back do we go? Oh, good, 20 years. So it might surprise you that one kind of outperforms. Yeah. So they don't all track an index the same. Now this is 20 years, but still, that's notable. That difference surprises me, that it's that much. Let's do something real quick. This has got me curious. Let's go back to the Schwab fund. Where to go? SP. I want to go to portfolio for a second for both of these and go down to let's just start with PE. It's 2123 for Vanguard and 2181. It's interesting that they're different. And let's look at Apple. So 678 for Schwab, 571. See, okay, I wasn't expecting to sort of find this. When I went down this path, I thought, it could be a little difference, but not a big difference. There's an example. There's a significant difference. I don't know which one is better. Let's see. This is holdings as of December 31. What is this? Yeah, still December 31. Current S&P 500 companies. See if I can get a current percentage. So that's interesting. So that's current though, but I'm looking here. The current weight on the S&P for Apple is over 7%. So in that sense, we don't know what these funds are. See, that's the problem with a mutual fund. We don't see current. Like if we go to VU, I wonder if they should show us. I think maybe current, maybe not. Let's see. Yeah, now it says as of December, so we don't know what they're holding now. But yeah, there were some differences there. That kind of surprises me that the differences were that significant. So it's worth looking at that. But how you judge which one's better, I mean, you kind of want to know which one more closely tracks the S&P 500. I don't know if there's an easy way to figure that out. Let's see. Let's Google it. Which S&P 500 index fund most closely tracks the S&P 500? Yeah, it doesn't really tell us. I might look into that too, but in any event, there you go. Mike says, and this is the pink wig guy, you do know you are factor investing with the small value index fund. Yeah, I know. Yep. You're factor investing unless your US to international ratio is identical to the market. You factor investor, you. I think we're all factor investors at some level, probably. All right. How are we doing on time? All right. Whoops. I think I'm getting close to the end of the questions. That hasn't happened in a few weeks. I've only got one question left, and unless someone adds more by the time I answer it. This allows me to play chess early. I'm finally playing in a tournament, by the way, the Amateur East tournament in Parsippany, New Jersey. You know, they don't let you pump your own gas in New Jersey. I think that's un-American. All right, Connor. Hey, Rob. I'm 19, and a little over a month ago, I hit $50,000 between my accounts. That is amazing. You should be doing this show. That's incredible. My question for you is how you recommend living and saving. How much is too much, and is that even possible? I mean, how much savings is too much? I think there's obviously no one answer to that. It depends on your goals. I do think it's worth trying to figure out how to be as happy and content in life as we can and still keeping a savings rate that's pretty significant. Obviously, there's some times in life where you need to spend all your money. That was certainly true for us. When I graduated from law school, we had nothing and a mountain of debt. I mean, my law school debt in 1992, in today's dollars, would be close to 200,000, I guess, between 150 and 200. And we had very little to save. It's an understatement. We had no assets. But there are periods of times when you can't save. But I think, to me, at a minimum, if your goal, for me, my goal is always to, at a minimum, to get to 20%. If I could save more, that's great. But you do have to weigh, living life today versus tomorrow. The thing, though, that I think a lot of people find out later in life is that some of the ways they may have spent money when they were younger didn't produce the happiness and contentment that maybe at the time they thought it did or would. But that's a highly personal question. There's no answer to it. But I think whatever you're doing is amazing. 50 grand. Boy, I wish I could have said that at the age of 19. I could not. All right. Well, I must have jinxed myself because now all these questions appeared. Salty says, beware your age. When you hit between 60 and 63, you will feel it. Well, gee, Salty, that gives me something to look forward to. I feel it now, for what it's worth. I go to a chiropractor / physical therapist twice a week. I'm going later today. She basically does very painful things to me. But it's supposed to help. And she's pretty good. TT, if we use a cash cushion bucket in retirement, how would we simulate that in FI Calc? Oh, well, you can do that. In big down years, I would just supplement from my cash cushion. So that's the bucket strategy, TT. I'm personally not a fan of it, but it's an approach and many people follow it. I started to say you could certainly include it here, right? So like, let's say you were, I don't know, 70% equities, 25% bonds, I'm just making it up, and 5% cash. What I don't know, that's in your allocation, but what you're suggesting is a withdrawal strategy. There could be, let's look at Guyton Klinger. So Guyton Klinger, here's what I would suggest. I'm not going to dig into it now because it would take some time. You might look at Guyton Klinger, and by the way, for all these strategies, you can click this blue link. It tells you about it. And then you have these tips for some of them. So they have ways with these factors where you might be able to simulate it potentially. You need to dig into this. But that's what you'd be looking at. I don't think you can simulate that with just the constant dollar, basically a simple Bingen rule. I would try, I don't know what some of these are, but you might try Guyton Klinger. I don't know what sensible withdrawals is. What is that? It's a various constant dollar withdrawal. You choose a base withdrawal rate. Oh, that's just a base rate. So you might try Guyton Klinger. You might be able to simulate it, or some of these other strategies might work. If they don't, then you can't do it with that tool. The problem I have with the bucket strategy is, in theory, it makes sense. I'll take from cash when the market goes down. But what happens if your cash runs out before the market goes back up? Now what do you do? And and why are we doing this in the first place? If the reason is we don't want to sell stocks when stocks are down, well, isn't just basic rebalancing of your portfolio every year, if between stocks and fixed income, doesn't that take care of it? Not only do you not buy in down years, or you don't sell in down years, you actually buy more stocks when by virtue of rebalancing. And isn't that what we want to do? And if you just sort of ignore that and just take from the cash, yeah, you're not selling, but shouldn't you actually be buying in a down year? You're not doing that either. Anyway, that's my thinking. Brett, he said I missed his question. I'm sorry, but he does say it's a silly one. So let's see. Why do you have Pac-Man from your thumbnails? Well, I'm very disappointed in that question because it's not Pac-Man. Anyone? Bueller? I'm pulling it up. Where's my channel? Here it is. It's Miss Pac-Man. At least I think that's what it is. That's what it's supposed to be. And it's that because I was a Miss Pac-Man champ in college. I mean, I don't want to brag or anything. And I just thought it was fun and goofy. And it was easy. Threw it up there. No good reason, but that's a very serious question. That's not silly at all. My best game was Donkey Kong Jr., which was a fun game. And I was good at it because I worked at Mr. Heroes, a sub shop, and I would close most nights, which would have me there till like 1 a.m, including on a school night. I don't know, is that legal? Anyway, but after we got done cleaning up, we'd play, Donkey Kong Jr. for hours. It's great. Okay. Bob, I'm trying to better understand the fees that I'm paying. Should I add advisor fees to the individual ETF and mutual fund fees? Is 1% or less acceptable? So you definitely want to add the fee, assuming you're paying your advisor 1%. That's in addition to whatever the fees are on the investments they have you in. So you absolutely want to add that. So for the funds, each fund, you take the fee times how much you have in that fund, right? Effectively a weighted average. You could do this in Personal Capital, just connect all your accounts. But if you didn't want to do that, you could just, do it by hand, spreadsheet or pen and paper. Pen and paper. And just do a weighted average and then add the 1% or whatever your advisor is charging you. Yeah. And here's the thing. I've never used an advisor, but I have a question for you guys that do. So we know in a mutual fund, when you get your statement, they don't tell you what your fees are. They don't say, okay, here's your balance minus, we took out our 7 basis points or 100 basis points fee or whatever it is, and here's what you got left. At least none of my statements do. And I think they should. I think that should be a regulatory requirement. I'm curious if advisors do that. My guess is they don't unless they have to, because why would they highlight the fact that you're paying lots of money to them? But for those of you that use an advisor, when you get your statement, does it tell you how much you've paid them? I'm curious. Conscience wants to know, what are your thoughts on 60% VTI, 20% VTWV, and 20% VXUS in taxable or Roth at age 30? I don't know or at least I don't think I do. VTWV? Oh, the Russell 2000. So here's VTWV. It's Russell 2000. So it's 100% stock portfolio. So you know my views on that. Beyond that, VXUS, one question I would have for VXUS in a taxable account is what percentage, I don't know the answer to this, but you could probably find out from Vanguard, what percentage of their dividends are not qualified, right? That would be a tax issue. The other question that I would have for you is why this fund and VTI? These are just questions. I'm not saying it's like wrong or whatever. And the way I would look at this, let me see if I can find, give me a second here. Why can't I find, bear with me. Here it is. I would put those two funds, maybe there's not much overlap, but you have this ETF overlap tool, etfrc.com. You can just Google ETF overlap tool. So again, we got VTI, and then we've got VTWV. There might not be much overlap. I don't know. Oh, there's not. So let me go back to this fund. So this is basically what? Small and yeah, so it's a small value. Yeah. I mean, again, I have questions about 100% stock. I have questions about VXUS and a taxable account. But from just a stock allocation perspective, it's 80-20 US to international. To me, that's within the range of reasonable. And you've tilted it towards small cap value. I mean, that's an approach I've taken for a long time. So I've got no arguments there. I mean, again, at age 30, if this is for retirement, certainly the argument can be made for 100% stocks, notwithstanding my own views on it. But Akeem, if you have $10,000 right now and I had to pick one stock, what would it be and why? Well, on a risk-adjusted basis, it's probably hard to beat I-bonds right now on a risk-adjusted basis. But if I had to pick one stock right now, I don't know. One stock. You guys are tough. I mean, I still like my Wells Fargo stock, but I bought it at cheaper prices. I bought it when its price to book was under 1. It's now 1.36. One thing I like about the banks, like on a day like today, it's all red except my banks. They're both green. Of course, tomorrow they'll be red. Akeem, honestly, I don't know that I have an answer. I don't have some stock that I'm itching to buy. Yeah. If you've never been to the Berkshire Hathaway annual meeting, and hopefully they have it in person, to me, that would be worth buying some Berkshire Hathaway. If they have it in person, we ought to have like a meetup because, well, I guess it's coming up now, isn't it? I mean, in May. They probably won't have it in person. So Conan says, everyone seems to leave real estate investments out of withdrawal rate calculations. Really? Those funds can be accessed, especially in a planned downsize. Those funds, oh, you mean the funds from individually owned real estate? Why not include them? I don't know why I mean, if you've got income from real estate, I suppose, I don't know why you wouldn't include that in your analysis. I don't know. Jonathan. Trying to decide if I should wait to convert stocks to index funds. I'm 66. Might retire by 70, but salary will go down. Is it worth waiting? So your point is your salary goes down. So here's the things that at least that I would think about. I'm no tax expert. Salary goes down maybe to 0, right? You could have some years in which you could have capital gains at 0% at the federal level in theory. But by then you're taking Social Security, so that's going to have to be factored in. By then, or you're presumably already on Medicare now at 66, so you have to factor in income as it would affect IRMA, and that's a cliff, right? So like if you go $1 over, and I can show you the IRMA thresholds. This isn't something I've had to deal with, but because I'm not 83, but here they are from, this is from the Social Security Administration. This is single head of household, the different incomes, modified adjusted gross income. So you've got to factor in IRMA. At 70, you're just 2 years away from RMDs. So you have to factor in the RMDs and how that's going to affect your taxes. So, this, I'm not giving you tax advice, of course, but those are at least some of the issues I would think through. So waiting till you're 70 may or may not be a good idea. You could already be taking Social Security, or you could be waiting till you're 70. You know, um, you could hire a tax professional to run some analysis for you. You could model it on your own in new retirement. It takes some time to learn the tool. It's not a tool that you could just load up and have an answer in 5 minutes. Um, but those would be some of the things, Jonathan, that I would think about in that situation. All right, Mark, is 80/20 VU BND, so S&P 500, 80%, total US bond market, 20%, all I need to invest for the long term? I think it's a perfectly reasonable long-term investment. At 22 years old, is it enough? I'm not sure what you mean, is it enough? Oh, I see. Do I just keep investing into it until retirement? Well, so it's not the approach I would take. It is very similar to the approach Warren Buffett recommends that the trustees follow for his wife when he passes away and his wife gets what I'm sure is a lot more money than at least I have. Um, but he's 90/10. So, I can't say that it's a bad approach. For me, at 22, 80/20 is too conservative. And I would probably choose VTI, total US market, over just the S&P 500. But we've looked at it in the past. The results over periods of time are very similar. I personally would have international exposure. But having said that, if we were to draw a big circle and say, what are all the reasonable approaches to what we're doing for long-term investing? Let's put them all in the circle. Would a VU BND 80/20 be in that circle? I think it would be. That's my opinion. We all got to be in the circle, one big happy circle. All right. Arun wants to know, what are your fund allocations in your 6-fund portfolio? I've actually been adjusting it slightly, but it's because of my stock allocation. But basically, I did a video on this. I think it was around 25%. I don't have it up in front of me, but 25%, let's say US stocks, 10% small cap US stocks. So what's that? That's 35. 15% international, like total international. So that's 50, if I'm doing the math correctly. 10% emerging, that's 60. Yeah. 10% REITs, that's 70. And then roughly 30% in tips and bonds. Now, apart from that, I have individual stocks. And I don't include those in calculating that asset allocation, but I do consider the whole thing at one time from a stock bond perspective. And all of that puts my total stock bond allocation around 80/20, which when I actually do get to the point of retiring in the sense of drawing money down, because right now I'm not, I'll probably get a little more conservative than that, maybe 70/30. I don't know yet. We'll see. Yeah, that's it. Can you talk about a kid's Roth IRA account, especially how to get earned income part before funding? So in other words, how can your kids make money? Because you got to make money to put money in a Roth IRA. I mean, there are ways. How can kids earn money for Roth IRA? The thing you don't want to do is get cute about this, right? But if your kids, I'm just looking, here's a source. This is actually from Fidelity. So you could Google this, turbocharge your child's retirement with a Roth IRA for kids. They talk about things like mowing grass and babysitting. What some folks will do is get children that are going to be, they're going to be, I won't say models, but they're going to use their images for, I don't know. That to me was always just kind of more effort than it was. But they got to make money. Can they babysit for you if you have older kids and younger kids? And I personally would get a little nervous about all that kind of thing. I mean, if you have your own business and they want to work for your business, but are they legitimately working and making a reasonable amount? You just got to make sure you do that correctly. I don't know if there's some sort of like safe harbors. Probably not for something like that, but you can always ask a tax pro. I mean, and why shouldn't they work? I think working when I was a kid was a good thing for me. LT says, yesterday was thinking of selling around 5,000 from our HSA. From which account would you sell from? SWPPX or VUG? Well, I would have an overall asset allocation. And if I were going to sell, I'm assuming you're selling because you're going to spend the money. I guess that's an assumption. Are you selling just to go to cash? Then the question is why? Why would you do that? But if you're selling because you're going to use it, then I would just reallocate. Now, $5,000 might not trigger a rebalance for you if you're looking at all of your accounts, not just the HSA. But having said all of that, SWPPX is the S&P 500 that we just looked at. And VUG, well, so really what I think you're asking me, VUG is a Vanguard Growth Fund, is which fund will outperform the other in the short term? I'm reinterpreting your question. The short answer is I have no idea. The longer answer is if I had to guess, I would think I would sell VUG if I were guessing. And it's just based on valuations. Which then, could mean I'm wrong. Salty monkey, it's not the kettlebells that are the problem. Kettlebells are great. In fact, I got one right here. It's an 8K-er, 16 pounds. But you can't hurt yourself. Like I don't do swings right now because of my lower back, but a Turkish get up ain't nothing better than that. And with a shoulder issue, you can hold these things in what's called a rack position. So like this, you don't have to hold them over your head, which would be a normal Turkish get up, right? Because of shoulder issues, particularly on the right side, I just hold them in the rack position. All right, time for one or two more. Probably won't involve kettlebells, but you never know. Mark. Any thoughts or strategy on transitioning from 100% stocks to 65-35 by retirement? So I do have a thought about that. I was thinking about that for myself. Not those specific numbers, but the same concept. Hang on, let me move this. Oh, my back! Just kidding. What I would suggest, the way I'm going to do it, and I don't have as big a move as you do. That's pretty significant. I would document something. I would put it in writing and have a set schedule. That to me is the most important thing, more important than the schedule itself. And it's the only way I know that I can prevent myself from trying to time the market is to have a schedule. So once a year, I'm going to go down by 5% or whatever the schedule is. That's what I would do. I don't know that I would do it all at once. I probably wouldn't do it all at once, at least not that big, because if I wanted 65-35 at retirement, it's hard for me to imagine that 1 year before retirement, I would want 100%, right? So I don't know if I'd start like 5 years before and do 5% a year or whatever, 35, 5 to 7% a year, break it up, maybe, right? That'd be my thinking. If I want 65-35 in 2025, let's just assume that's when I'm going to retire. Yeah, I wouldn't want 100% just 1 year earlier. Yeah, that's how I think about it. All right, I got time for one more. And that question I've already answered. All right. Yes, Salty, swinging it, yeah, that's a problem. I think I've answered all the questions. Yes, and it's 12:59. This is like the best live stream ever. All right, gang. Well, I'm glad you joined. Hopefully the audio didn't break up this time. And I will be back Monday night at 7 p.m. Lord willing and the creek don't rise. Wait a minute. There is a slight chance I won't be back Monday at 7 p.m. But if I am, you'll see it announced an hour or two before. because we will be traveling on Monday. But I'm pretty sure I'll be back in plenty of time to do a 7 p.m. show for an hour and a half. And then, of course, next Thursday at this time as well. Thrilled that so many people join. You guys really brighten up my week, and I thank you for that. And yeah, that's it. So have a great weekend. We can all enjoy the Bengals winning the Super Bowl, and then we'll meet back here hopefully Monday night at 7 p.m. Until then, remember, the best thing money can buy is financial freedom and a few kettlebells.